Good morning, ladies and gentlemen. It is a great pleasure to address this prestigious conference today on behalf of the Geneva Association on the topic of insurance, the role of insurance in modern societies. Let me quickly introduce the agenda of my talk today. First, please allow me to spend a few minutes on who the Geneva Association is. Secondly, I would like to present you some hard facts and figures on the economic relevance of insurance to the global economy. Third, I will address specific ways of how insurance can promote economic growth and societal resilience. The fourth item on the agenda will then explore the pandemic. And how it has affected, how it will affect the future role of insurance in society. And last but not least, a few key takeaways and a few questions which I am not able to answer today, but a few questions we may all want to think about going forward. Now, very quickly on the Geneva Association, we are the only global association of insurance companies, founded in 1973 in Geneva, which is why we carry our name. The key founders were insurance CEOs from basically from Italy and from France, as well as from Germany and a few other European countries. And nowadays we have 76 members. All these members are CEOs or chairmen of their companies, and I'm proud to report that Latin America is represented through 6 CEOs from Argentina, Brazil, Chile, and Colombia. In total, our member companies manage more than $17 trillion in assets. And what is probably even more impressive is the fact that almost 2 billion people worldwide are policyholders of the companies represented in the Geneva Association. Our main role, and this is why I'm talking to you today, is research. So we are a think tank. Our main task is to explore and investigate key trends for the global insurance industry. So with that, let me come to the substance. The insurance industry, and this is somewhat unknown, this fact is somewhat unknown, is a significant part of the global economy. More than 7% of the world's GDP is accounted for by insurance premiums, more than 7% of GDP. And there are a number of countries where this threshold, where this share is even higher than 10%. Now, North America is still the largest regional market for insurance. And when I talk about insurance, I include everything: property and casualty, health, and life insurance. And the fact that North America is still the dominant is primarily due to the huge health insurance business in the United States. As many of you may know, private health insurance plays a major role in providing for healthcare coverage in the US. Another reason is that liability insurance is of disproportionate importance in the United States, and this comes with a lot of premium income. But what we also see from this table, which is taken from Sigma, from the Swiss Re Institute, what you also see from this table is that the weights are shifting. You know, Asia Pacific is growing much faster than most other regions. And in 2020, for the first time ever, a premium volume from Asia Pacific has exceeded premium volume from the EMEA region, from Europe, Middle East, and Africa. Now, the final bullet here is about our role in financial intermediation. The insurance industry worldwide manages about $30 trillion US, assets under management of $30 trillion US. This makes our industry, one of the biggest institutional investors, alongside pension funds and alongside mutual funds. And if you recall, the Geneva Association members manage more than 17 trillion out of these total estimated 30 trillion US dollars in assets. So that's the big picture, and I think this already gives a powerful indication of the relevance of our industry to modern economies and societies. Now, let's dig a bit deeper and take a look at the non-life portion of the business. And what is quite interesting from this slide is that health insurance actually accounts for the lion's share, or well, at least for almost 50% of non-life insurance premiums. Again, this is due to the fact that the US market is that significant on the health side, with premium income of close to $1 trillion in the US alone for health business. Now, personal lines rank second, and not surprisingly, when you look at personal lines and the composition, the motor insurance part is the dominant piece. Now, another deep dive, and this time on the life side, life insurance side. What is most interesting here is the right-hand part of this figure, of this exhibit. It shows the split between so-called savings premiums and risk premiums. So savings premiums that are, that reflect savings decisions by policyholders versus risk premiums, which primarily cover biometric risks, such as the risk of premature death or disability. And what's quite interesting to see is that the share of savings premiums is eroding. And that seems to be also, when you go further down to historical data, that seems to be an established trend. And that is driven obviously by low interest rates. Low interest rates have clearly dented the appeal of savings type life insurance business. And at the same time, not least due to the pandemic, we have seen a rising awareness of mortality risk, the risk of dying prematurely. So people are buying more term life insurance, also in light of the pandemic. But having said this, the majority of the business, the lion's share of the business, is still savings business. And this underpins the enormous role of the insurance industry and the life insurance industry in financial intermediation. Now, so much for the facts and figures. What I would like to share now with you is a theoretical framework on how insurance promotes economic growth and resilience. It has been introduced by Professor Harold Skipper more than 20 years ago. Harold Skipper from the Georgia State University, and it's still pretty much standard when discussing specific ways of insurers promoting economic growth and resilience. Let me go clockwise and starting with the promotion of financial stability. This is almost a no-brainer. Insurers offer protection to individuals, to families, to businesses, and by doing so, they offer peace of mind. Some people even talk about sleep insurance. This is something, peace of mind, which we should not underestimate. It's of crucial importance also to unleash the creative powers of small entrepreneurs, for example. So this is difficult to measure, but in practice, it plays a very, very important role. The second contribution is the substitution for government security programs. So private sector insurance, especially life insurance, can replace or complement government security programs for old age security, for example. So this is something that we observe in many countries, and this is something that is being actively encouraged by many governments through tax incentives afforded to those who invest in or who buy life insurance policies. Now, the substitution for government security programs obviously reflects fiscal challenges in many countries. So publicly sponsored retirement schemes, for example, are reaching the limits of their financial viability. And that's why governments increasingly encourage the private sector to play a bigger role in providing for old age security. The third aspect which I would like to mention is the facilitation of trade and commerce. And this can be explained in very, very simple terms. No airplane would fly without insurance. This is what we have seen after the terrorist attacks in September 11th, 2001. This was a very powerful demonstration how critical insurance is to the global aviation industry. Similarly, ships would not sail without insurance, and trucks would not operate without insurance. So I think this contribution is very obvious and easily understood. Now, then moving further clockwise, the mobilization of savings. I already mentioned that the global insurance industry is managing assets of about 30 trillion US dollars. Most of this is obviously generated by long-term business, life insurance business. So life insurance products encourage people to save. They incentivize people to save. And as we know from economic theory, the savings rate is usually positively correlated with economic growth. So this contribution as well makes sense from an overall macroeconomic perspective. Now, moving on to more efficient risk management. Obviously, risk management is the core business of insurance. This is about risk pricing, risk assessment. Through pricing insurance policies, we are sending out signals to policyholders. We help policyholders understand the risks they are running. We help them put a price tag on risks. And this, in an aggregate way, should help society deal with risk more professionally and more rationally. And more sophisticated approach to risk management is obviously a positive from an economic growth and resilience point of view. Now, the second to last item, encouragement of loss mitigation. It is obvious that insurers have a strong interest in promoting loss mitigation, loss prevention measures and activities in order to reduce their losses, in order to protect their balance sheets, in order to protect their income statements. But by doing so, they generate what we as economists would call a positive externality for society. So by pursuing these corporate-specific objectives, insurers contribute to de-risking society and the economy as a whole. And last but not least, more efficient capital allocation. Again, I would like to remind you of the massive role of insurers as institutional investors. So insurers, given their reliance also on investment income, apply a very strong due diligence before they make investment decisions. They are professional investors. They are long-term investors with a long-term horizon. And this, in total, should lead to a more efficient capital allocation for the economy at large. So I think these seven specific areas are a powerful illustration of the macroeconomic importance of insurance and the fundamental business model of insurance. Now, let us enter the pandemic as a game-changing event, as an event that has reshaped the global risk landscape. And let's think a little about how the pandemic will affect or is affecting, as we speak, the role of insurers in modern societies. The most obvious post-pandemic trend is obviously digitalization. I mean, we all went through a crash course in digitalization as a result of the pandemic, as individuals, as households, as businesses. And the pandemic is expected to change customer habits and expectations for good. You know, there's a strong belief that, you know, customers and other actors, economic actors, will not go back to their pre-pandemic habits. So the reliance on digital technologies will have increased for good. This has obviously advantages, which we could all name, but it comes at a cost, and the cost is structurally elevated digital risk. This is something we need to be aware of. This is something insurers are obviously particularly interested in, and not only those who underwrite cyber risk, but also other insurers, because insurance is a data-sensitive industry, and the potential damage from data breaches could be enormous for insurance companies, whether they underwrite cyber business or not. Talking about cyber insurance, as many of you will know, this is a very small business, and the demand for it has increased quite significantly as a result of the pandemic and as a result of growing risk awareness of cyber issues. So that's an opportunity for cyber insurers. Another opportunity that is specific to insurance is the fact that, you know, when it comes to adopting digital technologies and approaches, insurers were perceived as being the laggards, as being slightly behind the curve. And this has arguably changed now as a result of the pandemic. And we are seeing many insurers stepping up their efforts to revolutionize customer interaction based on digital, or to bring down their operational or their distribution costs based on digital technology. So as you see, this is a very complex post-pandemic trend, a very complex element of the new post-pandemic risk landscape, which clearly affects the role of insurance, the future role of insurance in society. Another lasting trend or lasting legacy, if you like, from the pandemic is what some people call big government. The role of governments has increased quite significantly as a result of the pandemic. Governments have spent trillions of dollars to cushion the impact of the pandemic. So public balance sheets have surged. And, you know, some people have now come to the conclusion, well, if something really bad, such a pandemic happens, the government will come to the rescue, the government will bail out society. And obviously this bailout mentality is not conducive to insurance demand. So we have to watch this very carefully as insurers. Another aspect, another implication of big government is a higher tolerance of inflation, because, you know, these trillions of dollars of increased public debt need to be serviced. You know, there's a cost attached to this. So will governments encourage central banks to raise interest rates to fight inflation? Not sure about that. There are difficult trade-offs, and that's why, in light of this massive debt pile, public debt pile, we might see a bigger tolerance towards inflation. And this obviously has dramatic implications, potentially dramatic implications for the insurance industry. On the property and casualty side, it affects the adequacy of loss reserves, for example, as most of you know. And on the life side, I think the effects, the short-term effects are less dramatic, but the long-term effects could be really, really problematic, because inflation clearly erodes the value, the current value of fixed future payments. So you can argue that inflation is highly detrimental to the long-term value proposition of life insurance. Now let me add an aspect that is very, very close to our agenda here at the Geneva Association: societal risk awareness, the issue of protection gaps. What we have clearly seen as a result of the pandemic is what you may call a pivot to risk awareness. It remains to be seen whether this is a lasting trend or just something that would fade over time as memories of the pandemic start to fade. But anyhow, the pandemic, COVID-19, was clearly a wake-up call for many people, for many businesses. They now much better understand the protection shortfalls that affect their livelihoods, their lives, their health. And this is a great opportunity for the insurance industry, you know, to capitalize on this increased risk awareness and to make more effective moves towards narrowing protection gaps. And the slide here shows very, very impressively what we are talking about. We are talking about huge numbers. What you see here are protection gaps estimated as premium equivalents. So this tells us, you know, this shows us the additional premium volume worldwide, assuming that all these protection gaps were to be closed. And in total, we talk about $1.4 trillion. So you can argue that the global industry, the global insurance industry, punches above its weight, below its weight in the amount of $1.4 trillion. So if all these gaps were to be closed, the premium income for all insurers globally would be $1.4 trillion higher. This is what this estimate here, again taken from the Swiss Re Institute, tells us. And it's quite interesting to see that the health protection gap, which, you know, has been highlighted by the pandemic, obviously, is by far the biggest. You know, the public discussion very much focuses on natural disasters, but you see that you know, in absolute terms, the health part is really the major issue. So basically, we talk here about people's exposure to financially catastrophic healthcare expenditure. So the potentially ruinous effects of unexpected healthcare expenditure in the absence of health insurance. The second most relevant part is mortality protection. So a family faced with the premature death of the main breadwinner, the loss in income, this is what is measured here by these $408 billion US. And then last but not least, natural disasters. We are all familiar with this. This talks about the difference between the economic loss of an earthquake, for example, and the insured loss. And the delta is what we call the protection gap, which can then be translated into premium equivalents of more than $200 billion worldwide. So I think this is a very, very powerful graph, and this demonstrates the potential that the global insurance industry has to respond to the pandemic and to the growing risk awareness as a result of the pandemic. What I found particularly interesting, talking about Latin America, about the region you are most interested in, it's quite interesting to see that the health protection gap for Latin America, as indicated by this red dot here, is disproportionately high. So the share of Latin America in the global health protection gap is more than 10%. Yeah, this is much more than the share of Latin America in global health insurance premiums. So this is an interesting conclusion. The health protection gap in Latin America, according to these estimates, is of particular relevance and importance. Now, let me approach my conclusions. I would like to offer three key takeaways from my remarks. Number one, the industry has a golden opportunity to harness the heightened risk awareness to narrow protection gaps. We have been talking about protection gaps for long, but we consistently fail to make progress in narrowing them. Now we do have an opportunity to advance this cause based on a higher receptiveness of people towards the insurance product proposition and based on a better understanding of their vulnerabilities, be it health, be it life, be it business continuity for small businesses. So that's point number one. Point number two. Based on what I call this digital crash course, we have an opportunity to expedite business model innovation. You are certainly familiar with a number of major global insurance companies shifting their business models from pure risk transfer to also include risk prevention and risk mitigation. So not only paying or indemnifying people, but also helping people avoid losses. And obviously, modern technologies and analytics help a lot when you think of the Internet of Things or wearables, etc. So this is another major opportunity which would help our industry to become even more relevant for society, not only as a risk taker, but also as a risk manager or risk advisor for society. And last but not least, also relating to digitalization, I mentioned before that the insurance industry has been perceived as a laggard in adopting digitalization. We all know that transaction costs, especially distribution costs, still account for a significant share of premium income. So there is a significant scope of making our industry more cost efficient based on digital technologies, but maybe also to expand coverage, because you can argue that based on big data, based on artificial intelligence, it is much, this is a great facilitation of risk assessment, of risk analysis. And the better we understand risk, the better the higher our ability to actually assume risk. So one hypothesis is that modern technologies help expand the limits of insurability. And last but not least, we define customer engagement and experience. As we all know, insurance is not the most interactive business customers can engage in. And if customers engage with us, then more often than not, it is in a situation of distress and in a situation of stress. So we can really make a difference by adopting modern technologies and digital capabilities. Now, last but not least, a few questions which I have not addressed in my talk, but which I believe are of strategic importance to the global insurance industry. What I've shared with you in terms of the economic and societal value of insurance is still very much based on insights from the last century. Where most risks were bricks and mortar risks. Now, what we are seeing today is a rapid shift to intangible assets. When you look at the major stock exchanges worldwide, when you look at the assets composition of the listed companies, the vast majority of assets reflect intangible assets. Of course, this has to do with the massive growth of tech companies, but this is a major shift. So the question here is, what is our value proposition to a society that increasingly relies on intangible assets? That's food for thought. The second consideration is the notion of systemic risk. Systemic risk is risk that affects everyone at the same time for a prolonged period of time worldwide. precisely what we have seen during COVID-19 and what we might see on the cyber front. Imagine a scenario where we have a global outage of the internet. I mean, there are such scenarios, and this would be a systematic cyber risk. What's our contribution as insurers to such a scenario? I mean, it clearly challenges what we consider as insurable. Third, of course, I have to mention the geopolitical dislocation that we are experiencing at this point in time. This is likely to further dampen the risk appetite of insurers, both as underwriters and investors, and could lead to protection gaps in a number of areas. And point number 4, mounting economic inequality, also a very clear consequence of the pandemic. More and more people are asking, what can you guys contribute as insurers to alleviating or to mitigating economic or social inequalities? And last but not least, also as a result of the war in Europe, we could see a further acceleration of a trend that has already started a few years ago, an increasing fragmentation of the global economy, what some people call deglobalization. Deglobalization, which obviously is also a development that insurers need to explore from a risk landscape and risk analysis point of view. So the big question here is, and this is, I think, food for thought for anyone who has a vision for insurance, is how do we maintain our societal relevance in the face of these increasing challenges to insurability. So let me stop here, and I would like to thank you very much for your patient attention. Thank you. Yes, this is a very pertinent question. As I mentioned during my talk, there are increasing expectations from society as far as our industry's role in mitigating social inequality is concerned. I mean, let us start with some simple thoughts. Obviously, social inequality impairs people's ability to withstand shocks. Social inequality comes with unequal access to risk protection or unequal access to to risk education and the like. Think of the so-called health inequality phenomenon that has very tangible consequences, such as decreased longevity or higher mortality risk for socially disadvantaged groups. Or think of the natural catastrophe protection gap, which is particularly virulent in low-income segments of the population and also in low-income countries. Now, what can we do as insurers? Well, obviously there is something we call social insurance. So social insurance is used by many governments to address social inequality, to redistribute wealth and income from the rich to the poor. This is not the job of private insurance. This is not our mission. But having said this, private insurance can make a very, very important indirect contribution, which is pretty obvious. So if, for example, life insurance mitigates the risk of the main breadwinner of a family dying prematurely. And it is very clear that if life insurance is in place, the probability of a family falling into poverty in such a situation is much reduced. And I could give you other examples, different examples that would also underpin this indirect contribution of insurers to mitigating social inequality. And let me share another thought that is particularly relevant for developing countries where many, if not most, workers are employed in the informal sector. the informal sector, which is not reached, which is not covered by any social security systems that might be in place. Here, insurance can make a difference, especially if it comes based on simple, ineffective technologies, such as providing coverage through mobile phones, even through non-smart mobile phones. That for many people is the only access to, for many people in the informal sector, is the only access to risk protection. Yes, another very relevant question, and again, I could establish the link to the pandemic and the increased need for public-private collaboration. As I mentioned before, the pandemic has led to, in a number of countries, to what I would call a fiscal dislocation. So the fiscal abilities of governments have been severely dented by the additional expense or expenditure triggered by the pandemic. So also governments need to think more creatively about risk protection for societies, and that would suggest a bigger role for insurance. Even prior to the pandemic, there was a broad consensus that any comprehensive approach to mitigating or to narrowing protection gaps requires a multi-stakeholder effort. The precise configuration of this effort obviously depends on the maturity of the economy. But talking about developing markets, you can argue that there's a particularly important role for governments. Why? Because the degree of private sector risk transfer is limited. The risk-bearing capacity of the private insurance sector is limited, and at the same time, those societies are faced with huge protection gaps. So that calls for a strong role of governments in developing markets. So what could governments, with the support of insurers, do specifically? Just share a few thoughts. Obviously, what is always mentioned is compulsory insurance schemes. Compulsory insurance schemes which help establish a risk pool that is broad enough to become effective and efficient. And governments could ask private insurers to run these compulsory schemes, to administer them on behalf of the public sector. We are seeing this, for example, in a few countries in the Middle East, where health insurance is provided on that basis. A second example I would like to share with you is sovereign risk transfer. So governments joining pools to share risks with insurable risks with other governments. We have seen this in Africa, in the Caribbean, in the Pacific region, and here as well, insurers can play a major role as an advisor, but potentially also as ultimate risk absorbers. A third potential area for public-private collaboration is obviously risk prevention, the reduction of losses, which I mentioned before in my talk. You can approach protection gaps from two sides. Either you transfer risk to the balance sheets of the insurance industry, or you reduce risk in the first place. The end result is the same when you look at the size of the protection gap. So this, again, I think is a very important aspect. And finally, let me make this final remark. Insurers themselves, not talking about governments, insurers themselves, I think, have to step up their game by adopting modern technologies, by pushing digitalization, because this in many poor countries is probably the most promising way of dealing with protection gaps, of bringing distribution costs down, of also helping people better understand insurance and insurance value proposition. So this is something that any aspirational insurer who claims an interest in reducing protection gaps should promote, especially now with renewed effort after the pandemic and the societal imbalances and the social dislocation that we have seen as a result in a number of countries. Yeah, thank you for this question, which I already touched upon in my talk when I discussed what I called pivot to risk awareness. Well, let me go one step back. I think the starting point here should be financial literacy and financial education. You can argue that financial literacy is a prerequisite to risk awareness. It enables people to understand, to anticipate, and finally to manage the risks that they are facing. And from a low income or emerging markets point of view, there is an important distinction to be made between two types of risks people and their communities can be faced with. Number one is what we call idiosyncratic risk. So idiosyncratic risk is something that can be covered by informal protection mechanisms. For example, a community organized in a village where the majority is looking after the well-being of the minority. This works for relatively small risks, for example, individual sickness. It no longer works for what we can call covariate risks. Covariate risks are risks that affect the entire community. It's a shock to the entire community. Think of a pandemic, or think of a flood disaster, of an earthquake disaster. Here we need a different approach. So we can no longer rely on informal risk protection. Insurance solutions need to enter the equation. And this requires risk awareness. So people need to be made aware first and foremost about these big shocks, these so-called covariate shocks, such as natural disasters. Now, what can be done? Let me just share two thoughts with you. Government involvement is obviously a key success factors. We are seeing also the number of emerging countries, government efforts in place, in some cases with the participation of the private sector, including the insurance sector. I can give you an example from Asia. In the Philippines, the Department of Education has asked the local insurance association to help with the development of basic insurance modules that have been inserted into school curriculum. So this is an example, and obviously, as soon as governments change, as soon as public policy priorities change, this might get disrupted. So with this approach, we have a continuity issue, which is a main problem in practice. Another thought I would like to share, and I understand that you in Chile are particularly advanced in that respect, is making financial education a part of childhood education, making it mandatory for school curricula. Obviously, this is a very promising approach to fostering financial literacy, and based on that, to promoting risk awareness. Yeah, thank you very much for this question. Again, very relevant, very topical. Let me again make the link to the pandemic. The pandemic is expected to greatly add to the need and the value of microinsurance. Let's not forget that microinsurance has been designed for those who are unable to afford standard insurance products. And the number of those people has increased quite dramatically worldwide. Some of you may know the World Bank estimates that as a result of the pandemic, more than 100 million people worldwide have been pushed back into poverty. So this obviously adds to the importance of microinsurance in the post-pandemic world. Now, microinsurance, has had a mixed record of success in many countries. We have seen relatively limited breakthroughs. One of the reasons is the regulatory environment. I believe that microinsurance requires a distinct regulatory environment with lower capital requirements, with less onerous reporting requirements, with more flexibility in terms of distribution. Let's not forget that the cost of the last mile is the key obstacle to making microinsurance successful. The cost of distribution is disproportionately high given the small amount of premiums. So I think if governments, if their regulators more systematically address these issues, then microinsurance could really advance. Obviously, this is easier said than done, because regulators have the main role of regulators is to protect the customer, and microinsurance customers need to be protected even more than standard insurance customers, given the differences in risk awareness and risk understanding and financial literacy. So it's a different balancing act for governments and their regulators. But still, in order to advance microinsurance, to make the promise happen, and the promise has been around for many years. In order to make this happen, to make it reality, we need changes in the regulatory and underlying public policy environment. And there are examples. There are promising examples. Let me reference a research piece produced by the Access to Insurance Initiative, which some of you may be familiar with, in collaboration with the International Labour Organization. They looked at two regulatory initiatives they looked at two countries which reformed their microinsurance frameworks, namely Peru and the Philippines. And they clearly showed with hard data that in both countries, these regulatory initiatives led to an increasing number of insurers offering microinsurance, and led to an increasing number of policies issued. So this is a clear testament to to the fact that regulatory reform can actually work in the microinsurance and offers the potential to finally enable the breakthrough of this concept.